and welcome everyone. Thank you for joining us for this IAA member briefing. It has been an unprecedented year for all of us. We've had to grapple with the COVID-19 pandemic in both our professional and our personal lives. Firms have had to activate their business continuity plans and pivot overnight to a fully remote environment. It has all been fraught with new challenges. The IAA has worked hard to provide important resources for our members during this time. We have been, as you'll hear in this briefing, in frequent contact with regulators to both share and gather information and to seek and obtain regulatory relief. We have convened regular member calls to provide opportunities for all of you to share concerns, ideas, and best practices. And we have developed and curated a wide range of resources to help you navigate through this crisis. Our country has also been facing tremendous challenges from the racial inequities that persist to this day. We have a long way to go in matters of diversity, equity, and inclusion as a nation, and our profession reflects that as well. You'll hear on this call about efforts to address DE&I in our industry, and it will be through the SEC's Asset Management Advisory Committee, which is finishing a session right now as we speak. We can expect this to be a continued focus of policymakers and regulators. And the IAA is focusing on these critically important issues as well. Please reach out to us if you would like to get involved. I also want to mention the work this year of the IAA's Active Managers Council. The council is made up of IAA members and advocates for a balanced narrative on active and passive management. The council has made meaningful progress in debunking the false dichotomy of active versus passive and has educated the public and policymakers that both active and passive have important roles to play for investors in the markets. The council has engaged on the IAA's strong letter to the DOL on ESG. We've published research on how sustainable investing is an active process, and we're engaged with the Asset Manager Council on this issue. We have also published research on the limitations of the performance scorecards. Please let us know if you would like to get involved and go to activemanagers.com. And now I would like to introduce our panel today. We are going to be emceed by our amazing General Counsel, Gail Bernstein. She will be joined by our esteemed Vice President of Government Relations, Neil Simon, and our superb legal team, Sanjay Lamba, Sarah Busher, Monique Botkin, Laura Grossman, and Paul Glenn. Take it away, Gail.
Thank you, Karen. May, could you go to slide 4? Thank you. So here is a high-level agenda of what we plan to cover today. The SEC under Chairman Clayton and the Division of Investment Management under Dalia Blass have followed an aggressive agenda for regulation of investment advisors, and they have moved at breakneck speed to get it all done. The Department of Labor was fairly dormant earlier in the year, but it has ramped up its ERISA-related activities in recent months, and the CFTC also has been extremely ambitious under Chairman Heath Tarbett. Of course, there's always a lot to say about Capitol Hill, especially as we head into an election. As we go through each of these agenda items, we'll weave in trends that we're seeing or that we can expect to see, and we'll provide what we think are the most important takeaways. Slide 5, please, Megan. So I'm going to start with the pandemic and some of the unique regulatory challenges that it has created, and then I'll make a couple of observations about lessons learned. As Karen mentioned, the IAA has had discussions with the SEC, which began as early as late February, about issues that our members were beginning to face or were anticipating due to COVID-19. We began holding weekly member calls to discuss COVID-related challenges in March, and these calls have continued through now, even though the need for COVID-related regulatory relief is not as acute. We also held several webinars across a broad range of topics to help members navigate through this crisis. So I want to note just a few areas that the IAA discussed with the SEC and on which we got some relief. The first was an extension of the deadline for Form ADV filing and delivery. And we also got assurances from OC that it would not conduct BCP reviews during the pandemic, that's business continuity plans, at least during the early months. And also it would not request any BCP related information from smaller or mid-sized advisors outside of the context of an exam. The Commission also issued an order that exempts fund boards from holding in-person board meetings. This very welcome relief has been extended through the end of the year, and the SEC is now considering whether to issue a further extension or even to make the relief permanent. In August, OC issued a risk alert highlighting COVID-related compliance risks and considerations for advisors, and it provides a fairly detailed roadmap to help you think about compliance and supervision in the age of COVID. It covers 6 broad categories: protection of investor assets, supervision of personnel, practices relating to fees, expenses, and financial transactions, investment fraud, business continuity, and lastly, protection of sensitive client information. So let me say a few words about lessons that we've learned during this time. First, notwithstanding unprecedented market volatility, the markets seem to weather the storm pretty well. The SEC is definitely taking a look at whether some tweaks will be needed to how things like circuit breakers function, and there has been some concern with respect to liquidity and pricing in certain asset classes. But on the whole, the markets have handled this better than anyone could have predicted. Second, even if business continuity plans did not specifically contemplate a pandemic, it seems that for the most part, they have worked very well. Firms have been able to review and adjust them in real time, and they're likely to be even stronger going forward, having been tested under pretty extraordinary circumstances. Third, remote working, including the ability to supervise employees, has also worked better than anticipated. A final observation is that the pandemic has underscored the many different layers that firms must consider that actually have nothing to do with being an SEC-regulated entity. These include employment, safety, and privacy challenges, to name a few, and the different regulatory schemes that govern them. I'm pretty sure that we are likely to see more and more resources going to compliance in these non-SEC areas in time to come. Now, we could talk about the effects of COVID-19 for the full hour, but we have a lot of other topics to cover. So let me turn the floor over to Neil to talk policy and the 116th Congress.
Thanks, Gail. So let's move from slide 6 to slide 7. As I hope you know, a top legislative priority for IAA has been to gain a tax provision in the next stimulus package that would restore and make broadly applicable the previously available deduction for advisory service fees. This deduction had been available only for those whose itemized business deductions exceeded 2% of their AGI, but the 2017 Tax Cuts and Jobs Act eliminated it, along with most itemized business deductions. The IAA assembled a broad coalition on this issue to work the issue on the Hill, including the CFP Board, the Financial Planning Association, and the Financial Services Institute. And we have been meeting regularly with key lawmakers and their staffs to gain their support. Moving just briefly to slide 8, we have been invaluably assisted in this effort by the thousands of letters to Congress generated by you and your colleagues responding to our Take Action Now alerts. Thank you. And please keep those messages coming when we request them. They are critically important because it's local interest that makes our message resonate in the halls of Congress. Okay, back to slide 7. Unfortunately, it now appears unlikely that Congress will enact a new stimulus package. You're reading about it as we all are, at least before the elections. A bill could happen during the lame duck session, but that will depend upon the electoral outcome, the economy, and of course, the pandemic. In any event, our effort to educate lawmakers and gain advisory fee deductibility will, with your help, continue in the next Congress. The existing Tax Cuts Act provision expires in 2025, so Congress will have to eventually deal with it, so we need to make sure advisors' voices are heard. On another topic, we had high hopes for more bipartisan retirement savings legislation following early passage in this Congress of the Secure Act. The Portman-Cardin Act in particular had gained a lot of support on Capitol Hill and was supported by IAA. Among other things, it would have further increased the age for required minimum distributions, increased the catch-up contributions cap, and created tax incentives for small employers to set up defined benefit plans. Despite bipartisan support, congressional leadership, alas, did not make it a high enough priority. Although it too could come up in a lame duck, that appears unlikely. However, one thing that Congress did do, or at least the Senate, was to confirm some nominees for key regulatory posts. On August 6th, the Senate confirmed President Trump's nomination of Hester Peirce to serve a second term as an SEC commissioner, and of Caroline Crenshaw to fill the Democratic seat vacated by Robert Jackson in February. So, Laura, we are in one of those rare moments in modern history when the SEC has its full complement of 5 commissioners. Of course, Chairman Clayton is expected to step down regardless of whether Trump is reelected by early in the new year, so we will have an opening to be filled, presumably in Q1. And though not yet taken up by the Senate, over at the CFTC, President Trump on August 14th nominated Robert Bowes, a White House advisor and former banker, to replace Republican Commissioner Brian Quintenz, who did not seek renomination. The elections, of course, will be a focus of IAA's upcoming Leadership Week, October 5th through 8th. In fact, David Wasserman, House editor of the Cook Political Report and one of the nation's top election prognosticators, will be speaking on Tuesday, October 6th at 1:30. Take my word for it, it'll be good. In addition, other advocacy-related sessions include a panel of tax and politics experts discussing what's ahead for taxes in 2021-22, and a group of my fellow Capitol Hill insiders representing asset managers discussing their interests and concerns before Congress. And of course, we'll discuss IAA's advocacy and policy priorities. It would be great to have you there. So Gail, that's all I got. Back to you.
Thank you, Neil. Megan, slide 9, please. So now we're going to shift to the regulatory landscape. And as with possible changes in Congress, we are also likely to see some changes in regulatory priorities. And I'd say this is regardless of the outcome of the election. But as we've seen during this administration, deregulation or reversing prior regulation is at least as slow and as difficult as adopting new regulation. It is a cumbersome process and it takes time. Before we jump into specifics, I'd like to mention 2 items. First, Dahlia Blass recently gave a speech laying out what she wants to accomplish before year end. And much of what we'll be talking about today is on that list. So we are expecting a flurry of activity coming out of the SEC over the next few months. The second item I wanted to draw everyone's attention to is something Karen mentioned, the SEC's new Asset Management Advisory Committee, or AMAC. The AMAC was formed to provide the Commission with different perspectives on asset management. It's made up of a pretty broad group of individuals from investment firms, intermediaries, other market participants, and academics, and it's been given a high profile by this Commission. We expect that it's going to be an increasingly important resource for the SEC. The AMAC has met several times already this year, and as Karen mentioned, it is meeting as we speak. And it's formed 2 important subcommittees, one on ESG and one on private investments. Both of these topics are on today's agenda. It has also spent a great deal of time exploring issues around diversity in asset management, which is also being discussed today. Diversity in the industry is an increasingly high priority for the SEC, and I think for the industry, and we expect this conversation to continue. Now, turning to some specific regulatory initiative, let's start with developments relating to the SEC's Standards of Conduct package and the fiduciary duty more broadly. Meg, could you move to slide 10, please? Sanjay, the new client relationship summary went live very recently. How do you think it's been working?
Yeah, that's right, Gail. So as of June 30th, firms have been required to deliver a new disclosure document, Form CRS, to new and existing retail clients. Now, according to the SEC, Form CRS was intended to help retail investors, in effect individual investors, make informed choices regarding whether a brokerage or investment advisory relationship is appropriate for them, but also whether a particular broker-dealer or investment advisor best suits his or her particular needs. So to answer your question, Gail, it is relatively early, and to be fair, I think the jury is probably still out on the effectiveness of Form CRS. But by all accounts, I also think it's fair to say that Form CRS hasn't exactly turned out the way the SEC had hoped for, at least out of the gate. Based on press reports and feedback that I've received from some of you, clients aren't providing any feedback. Complete silence is the best way that it's been described. Now, this is particularly noteworthy given that the conversation starters in Form CRS were specifically designed to encourage your clients to ask you questions. Also, in late July, the SEC staff put out a statement regarding their initial reviews of Form CRS. While not providing much in the way of specifics, the staff noted that they identified good examples of clear disclosures, but they also identified examples that may lack certain disclosures or could be clearer or otherwise improved. On this point, I'd like to note that according to a recent Wall Street Journal article, their review of approximately 8,100 relationship summaries found that about 1,300 firms, including broker-dealers and investment advisors, incorrectly reported that neither they nor their financial representatives had any legal or disciplinary histories, which is required to be disclosed in Form CRS. And they also found that about 80 firms didn't provide any disclosures in response to this requirement. Also, in response to a request for a comment from the Wall Street Journal, the SEC spokeswoman said that staff members have observed areas where disclosures may be inaccurate or incomplete, and that the agency's examiners will formally review the filings to ensure that they are accurate and not misleading. The statement also indicated that the staff plans to engage with firms to share best practices and provide feedback on the filings. According to the staff, particular firms may need to consider ways to improve their relationship summaries and determine whether any specific amendments or a broader change in their overall approach would be appropriate. Now, the SEC staff indicated that they plan to hold a roundtable this fall where they plan to provide additional feedback regarding their observations. Now, the specific dates, times haven't been announced, and we'll be certainly to keep our members informed. So going forward, I would expect to see some firms, based on feedback they get from the SEC, to have to file amended versions of their Form CRS. I would also expect to see the SEC staff continue to publish Form CRS FAQs as issues emerge. And it is very likely that OC examiners will be carefully reviewing Form CRS as part of their exams. As noted in the Wall Street Journal, they'll likely review the accuracy of disclosures, particularly relating to disciplinary history. Now, I also want to note that earlier this year, OC issued a risk alert where they provided their expected scope and content of their initial examinations for compliance with Form CRS. They also issued a risk alert relating to Reg BI for broker-dealers. Now, we'll continue to organize calls of our Form CRS implementation group as significant issues arise, and will continue to serve as a conduit to the SEC staff regarding any questions or concerns you may have regarding Form CRS. Gail?
Thank you, Sanjay. So the bottom line is that we're going to be hearing and talking about CRS a lot in the coming year. There has been one other interesting development at the SEC relating to fiduciary that we think is worth mentioning. In early August, the President's Working Group on Financial Markets issued a report that examined the risks to investors in US financial markets posed by China's refusal to allow PCAOB audit firms to audit Chinese companies that are listed on US exchanges. The report made 5 separate recommendations for action by the SEC. 2 of these focus on the PCAOB, and 2 call for enhanced disclosures by registered funds, including, interestingly, index funds that have exposures to China and other non-conforming jurisdictions. The 5th recommendation is the most pertinent to advisors. It calls for additional guidance from the SEC with respect to advisors' fiduciary obligations when they consider investments in non-conforming jurisdictions. Chairman Clayton has tasked the staff to make recommendations to the Commission on each of these 5 points, and he's also invited public input. So we're working with members to decide whether to comment. It is the IAA's view that the fiduciary interpretation already covers what the PWG report is trying to do, and that there is no need to issue yet more guidance. Another arena for activity on the fiduciary duty is the Department of Labor, which recently published a new proposal. And I'd like to turn to Sarah. Sarah, what is the Department of Labor proposing to do?
Well, Gail, as a follow-up to its vacated fiduciary rule, the Department of Labor officially reinstated the earlier 5-part test to determine whether a person is an investment advice fiduciary. And they proposed an exemption to allow advice fiduciaries to receive compensation for providing fiduciary investment advice and to engage in certain principal transactions. This proposal, like the vacated rule, covers only non-discretionary advice. So its primary application for investment advisors providing discretionary management will likely be with respect to advice about rollovers. On rollovers, the DOL rejected a position that it took in 2005, which said that rollover guidance is not fiduciary investment advice. And now it says that rollover advice may be covered by the 5-part test. The exemption is also designed to be consistent with the SEC's Regulation Best Interest, or Reg BI for broker-dealers, and the SEC's fiduciary duty interpretation for investment advisors. Now, we commented on the proposal, and our 2 primary points were that the DOL should clarify that it does not intend to interpret the 5-part test to treat as an investment advisor as a fiduciary before it enters into a relationship with a client. We also commented that the exemption should apply to all digital advice. As proposed, it would only apply to digital advice that involved interaction with a person. The DOL held a hearing on the proposal on September 3rd. Those who testified from the broker-dealer and insurance industries were more supportive of the proposal because it is consistent with Reg BI. They did not like the change proposed for rollovers, though, and they also did not like the proposed requirement that firms have to acknowledge their fiduciary status. Consumer advocates, on the other hand, criticized the proposal because it does incorporate the Reg BI standard, which is not a fiduciary standard. They also argued that the exemption should not have a lower standard than the ERISA fiduciary standard. As for next steps, we do believe that the DOL wants to move ahead on this exemption, so stay tuned.
Thank you, Sarah. We're going to circle back to you in just a little bit to talk more about the Department of Labor. Slide 11, please. One of the most important rulemaking proposals, and the one that probably everybody in the audience is anticipating, that the SEC has sort of done in a long time, has been proposed changes to the advertising and solicitation rules. Sanjay, let's go back to you. Can you give us some thoughts on these proposals?
Sure, Gil. So according to a discussion we had with the SEC staff, in fact, just this week, we were informed that we should expect to see the SEC adopt significant amendments to these rules by the end of the year, if not sooner, which is a big deal because changes to these rules will have a major impact on your marketing activities to get new clients, but it could also, depending on how the final rules are written, severely impact your advisory-related communications with your existing clients to some extent. Now, I'll talk about the advertising rule, and then I'll turn it over to Laura to discuss the changes to the solicitation rule. So the good news is that the final amendments to the advertising rule will very likely replace the current per se prohibitions on past-specific recommendations and testimonials with principles-based provisions. The final rule will also likely permit the use of endorsements and third-party ratings subject to certain conditions, and the final rule will also recognize the difference between retail and sophisticated investors, including tailored requirements for the presentation of performance results based on the intended audience. So on balance, we believe that the amended advertising rule will be a huge improvement over the current regulatory framework. But we do have some fairly significant concerns over certain elements of the amended advertising rule as it was proposed. I'm not going to go over all our concerns. We had a lot to say in our 79-page comment letter to the SEC, but I do want to highlight a couple of key points for you. First, specifically, we have significant concerns regarding 2 substantial but interrelated provisions that were in the proposal. First, the expansive and overly exclusive proposed definition of advertising that we think would bring virtually all advisory communications within potential scope of the rule, and we're also concerned that it would blur the line between client servicing and marketing. You couple that with a new pre-approval requirement that was proposed that we think in practice would likely result in you having to review virtually all communications directed at clients, and potential clients prior to their use. Of course, this would impose an enormous burden on your compliance staff, but perhaps more importantly, would impose unnecessary constraints on your day-to-day communications with clients. The SEC staff is reviewing and considering our comments. In fact, we had one staff member tell us that they appreciate our comment letter and refer to it as the book. We also know that the SEC staff is proactively reaching out to the industry for additional feedback. We've had numerous SEC officials, including SEC commissioners and their staff. And based on these discussions, we are cautiously optimistic that the SEC will amend their proposed approach to reflect many of our concerns, particularly as they relate to our concerns on impeding communications with existing clients and the extreme burden that would be imposed by the review and approval requirement as proposed. Now let me turn it over to Laura to discuss the solicitation rule. Laura?
Yeah, so in the same release as the advertising rule proposal, the SEC also proposed significant changes to the solicitation rule, which will likely require changes to your policies and procedures around solicitation arrangements. For one, all forms of compensation would be covered under the SEC's proposal, rather than only cash compensation. This could include things like directed brokerage, sales prizes, entertainment, and free or discounted advisory services in exchange for referrals. The SEC also proposed to expand the rule to the solicitation of investors in private funds. The IAA opposes this, but we have advocated that if the SEC does proceed down this path, it should at a minimum exclude the solicitation of non-US investors in non-US private funds from the rule. In addition to these major amendments, the proposal also would change how disclosure is given to clients and how advisors verify whether a solicitor has complied with the rule. And it would expand the types of disciplinary events that trigger the rule's disqualification provision. It would also provide a de minimis exception for payments of less than $100 in any 12-month period. As Sanjay said, we are expecting a final rule relatively soon, likely with a 1-year compliance period. The IAA will provide resources to help you implement the final advertising and solicitation rules when they come out.
Great, thank you, Laura and Sanjay. Monique, let's turn to you. Another area that the SEC is working to modernize relates to broader access to the private markets. Can you tell us what the Commission is doing in this area, please?
Sure, thanks, Gail. Since last summer, the SEC began taking steps to harmonize and amend rules relating to the exempt offering process and access to private markets. In a first and welcome step, the SEC adopted amendments to expand the definitions of accredited investor and qualified institutional buyer that will permit more investors to qualify for certain private offerings. These amendments will be effective 60 days after publication in the Federal Register, and they largely follow the proposed amendments that the SEC issued. The IAA supported the proposed amendments and made several additional recommendations. We're pleased that the SEC modernized these definitions, especially expanding access to the private markets for institutional investors, changes which we have long advocated for. So the SEC created 2 new categories of natural person accredited investors. First, natural persons with certain designated professional certifications. So the SEC designated holders in good standing of the Series 7, 65, and 82 licenses, and it may consider adding additional certifications in the future. And second, natural persons that are knowledgeable employees of a private fund are accredited with respect to investments in that fund. And this was also something the IAA had asked for. The SEC amended the rules so that spousal equivalents may pool their finances for purposes of qualifying as accredited investors. The 2 new categories of entities that are interesting for IAA members would be SEC registered advisors themselves and investing on their own behalf. And the SEC also added a catch-all category that includes any entity, including foreign pension plans and foreign governments, or sovereign wealth funds that own investments over $5 million. And this is something the IAA had asked for from the SEC. Family offices with also $5 million in assets under management and their family clients are now accredited as well. The IAA is pleased that the SEC finally amended the definition of qualified institutional buyer for 144A resales of securities offered in a private placement without registration. So this definition now includes an institutional investor that meets the new catch-all category of institutional accredited investor, if they own and invest at least 100 million of securities of non-affiliated issuers. And this would include foreign pension plans and other institutional investors, and that's a change that we have urged the SEC to make for years. Unfortunately, the SEC did not adopt our recommendation that discretionary clients of SEC registered advisors be accredited investors in QUIBs. So fund advisors should be amending their fund documentation, policies and procedures, and disclosure to reflect these revised definitions. And advisors investing in private offerings on behalf of their clients should determine whether their clients now qualify as accredited investors or QUIBs under the amended definitions. Two other SEC initiatives in the exempt private markets area that we wanted to mention. First, the SEC proposed earlier this year to provide more flexibility in Reg D private offerings. The IAA supported this proposal in June, and we expect the SEC could act on this by the end of the year. And second, the staff is considering feedback on ways to structure registered closed-end private funds of funds, closed-end funds of private funds rather, that could provide retail investor access to private markets. And in fact, as mentioned earlier, the SEC's Asset Management Advisory Committee discussed this initiative earlier today. The IAA has scheduled a member call for this Friday to discuss potential recommendations that we could make to the SEC, so please let us know if you're interested in joining this call. Gail, back to you.
Great, thank you, Monique. Sarah, I'd like to turn back to you. We just held an excellent webinar on the SEC's recent actions on proxy voting. Can you share with us some of the key takeaways from that?
Yes, Gail. In our webinar, we discussed the rule for proxy advisory firms and the supplemental guidance for investment advisors. For proxy advisory firms, the SEC codified its view in a rule that advice provided by these firms is a solicitation under the Exchange Act. Now, we should note that that issue is currently being litigated. These firms will need to make certain disclosures and adopt policies and procedures reasonably designed to ensure that issuers have access to proxy advice before or at the same time as that advice is provided to clients of proxy advisory firms, including investment advisors. Proxy advisory firms also must provide their clients in a timely manner with a mechanism to make them aware of an issuer's input. The IAA opposed any steps that would make it harder for advisors to use the services of proxy advisory firms, and were pleased that the SEC significantly scaled back from its proposal and did not adopt the proposed advanced issuer review and notice requirements. Now, regarding the supplemental guidance for investment advisors, even though the SEC just issued guidance last August regarding proxy voting for investment advisors, it issued additional guidance this July. The new guidance focuses on advisors receiving additional information from issuers and on advisors' use of proxy advisory firms' voting execution services and pre-populated electronic voting platforms. The guidance discusses situations where the advisor becomes aware that the issuer filed or intends to file with the SEC additional information related to a proxy vote. This guidance may have been provided in lieu of forcing advisors to click on hyperlinks before voting or other types of forced speed bumps, which we strongly opposed. The new guidance also discusses fairly specific disclosure for advisors to provide to clients about the extent to which they use automated voting and how automated voting is addressed in their policies and procedures in cases where issuers have submitted additional information following a proxy advisory firm's advice. The SEC will expect this disclosure to be sufficiently detailed to enable a client to provide informed consent. Now, because this is guidance, the SEC did not provide a compliance date. While we do not believe this additional guidance was necessary, it is now in place, so you will want to review your policies, procedures, and disclosures and determine whether you need to make any updates. Gail?
Thank you, Sarah. Let's go to slide 12, please. So another area that the SEC is trying to modernize relates to reporting under Form 13F. Laura, you are working on an IAA response to a proposal that the SEC has put out on this. Can you tell us about those efforts, please?
That's right. The SEC has proposed to substantially reduce Form 13F reporting by increasing the reporting threshold for institutional investment managers that exercise investment discretion over 100 million or more in Section 13F securities to $3.5 billion or more. The $100 million threshold has never been updated since Form 13F was introduced in 1975, when it would have captured only the largest institutional managers. The proposal also would direct the SEC staff to review the Form 13F reporting threshold every 5 years, require the inclusion of certain small positions that managers may currently omit, which would increase the overall holdings information required from larger managers, require managers to report the CRD number and SEC filing number of itself, as well as any other manager, including in its own form, and narrow the ability of managers to obtain confidential treatment. Although when it was first adopted, Form 13F was intended to provide transparency into the holdings of the very largest investment managers, over the years, the information has come to be used for other purposes as well, which many of our members find quite beneficial. Because of this, while some smaller advisors would welcome an increase in the reporting threshold, many other members do not want to lose the benefits that they get from the transparency afforded by Form 13F. These benefits include that the reports help them conduct due diligence on other managers. They help sponsors to closed-end funds and ETFs monitor activist shareholder activity, and they help small advisors be recognized by issuers. So we're working with members to comment on this proposal. If you would like to participate and you're not already getting our communications on this, please feel free to contact me.
Great, thank you, Laura. And we are actually delighted to be able to put this next item in our briefing call and talk about it in a way that's a little bit more than just purely aspirational. Sanjay, it looks like the ACC may now be open to updates on e-delivery. This is an area that the IAA has been engaged in for a long time. Can you talk about some of these changes and what the IAA is sort of thinking about them?
Sure, yes. This is an extremely positive development. As Gil noted, the IAA has long advocated for the SEC to further promote the use of electronic delivery, or e-delivery, as a reliable and cost-efficient means for advisors to deliver required disclosures to clients. Specifically, in the past, we have asked the SEC to change the current delivery with consent model to a notice and access equals delivery approach. Under this approach, firms could either deliver required disclosures electronically, for example, via email, a PDF via email, or send a notice that could either be an email or in paper to clients informing them of the availability of new disclosures on the firm's website. Now, of course, clients would always have the ability to opt out and receive paper. Now, the SEC staff has asked the IAA to submit our recommendations regarding modifying the e-delivery framework. We are in the process of formulating our specific recommendations, and we do welcome and encourage your feedback. In the meantime, we have also joined with other trade groups on a discussion paper also advocating for e-delivery. The discussion paper will be made available to the public shortly. Now, I do want to note that the IAA joining the paper is separate and apart from our own continuing advocacy efforts. This includes providing specific recommendations to the SEC staff regarding an e-delivery framework that is both workable and cost-efficient for firms, but ensuring that investors get important disclosures. This is a high priority for us, so we do encourage members to provide us feedback, so please feel free to reach out to me directly. Gail?
Great, thank you, Sanjay. And this is really an exciting development, and we're definitely going to be engaged in it. Meg, could you move to slide 13, please? The discussion so far has given, I think, a pretty good flavor of the SEC's regulatory landscape. But Sanjay, let's stay with you. What are we seeing with respect to the Commission's enforcement and exam trends?
Sure, so let's talk about enforcement first. So the SEC's enforcement staff has been keeping busy, even though we're going through this pandemic. But in terms of big picture trends, the SEC continues to focus on issues affecting retail Main Street investors. This includes disclosures of conflicts of interest, but also includes situations where money is coming out of investors' pockets when it shouldn't be. These types of cases have involved errors in fee and expense calculations, as well as cases involving misallocating expenses to fund clients. Another big theme has to do with the accuracy of disclosures generally. The saying, say what you do what you say, comes to mind. For example, we still see cases involving the use of the word may in disclosures. Now, in terms of specific types of cases, the big focus continues to be mutual fund share class selection practices and disclosures regarding revenue sharing arrangements. These cases have also called into question practices relating to best execution obligations. Just a quick update on the SEC's Mutual Fund Sharecast Selection Disclosure Initiative, which, if you recall, offered favorable settlements to firms that self-reported potential disclosure and conflict issues. Since the voluntary initiative was announced in February 2018, the agency has reached settlements with a total of 98 investment advisors and returned more than $139 million to investors. In April of this year, the SEC announced that it's closed the self-reporting initiative with enforcement settlements against 3 investment advisors. Now, if you recall, when the SEC announced the initiative, they took a carrot and stick approach with promises to seek harsher penalties against firms that have failed to self-report. And I can tell you they've kept their promise. They've announced a series of enforcement settlements with firms that they noted were eligible to, but did not self-report as part of the SEC's self-reporting initiative. And we've also seen several cases in 2020 thus far. In fact, most recently, just last month, the SEC charged several investment advisors that didn't self-report in connection with share class selection practices and undisclosed revenue sharing arrangements. Another enforcement area for advisors involves the SEC's broader efforts to protect teachers' retirement plans. The SEC's teacher initiative, which was launched last year to address concerns with the limited scope and high costs of 403B and 457 plans. So we can expect this to be a continued focus. In fact, just this past month, we saw the SEC fine an investment advisor for a total of $40 million in 2 enforcement actions relating to this issue. So now let's turn over to the examinations program. Megan, if you could please switch the slide, thank you. So SEC examiners, like the entire SEC, most of them are working from home, but by all accounts, they're also keeping very busy. So in terms of their exam status, they currently are conducting exams remotely. They're doing a lot of desk reviews, but they will go on site if there's a significant investor protection concern. Now, as Gail discussed earlier, OC will certainly be focusing on BCPs, as well as the areas that were raised in the COVID risk alert that Gail outlined. I also want to mention that OC has established a new office within their program dealing with emerging and market-wide threats. And finally, I just want to note that it's very likely that the SEC exam program is working on their exam priorities for 2021, which will also be published early next year, as they have in past years. And finally, I just want to point out that OC continues to churn out risk alerts. So let me turn it over to my colleagues to discuss those. Monique, you want to start us off?
Sure, thanks, Sanjay. So this summer, you likely saw that OC issued a risk alert highlighting risks found in exams of private fund advisors. And this is an area that includes many topics that the SEC has talked about for many years, and including subjects of SEC enforcement actions, as Sanjay mentioned. The 3 main risk areas included in the risk alert are inadequate disclosures of conflicts of interest, inaccurate assessment or disclosure of fees and expenses, and deficiencies in policies and procedures designed to prevent misuse of material non-public information. So I'll provide some highlights from each risk area. On inadequate disclosure of conflicts of interest, OC pointed to a number of areas relating to conflicts in allocation of investments and co-investment opportunities, clients investing at different levels of the capital structure, economic relationships between the advisor and fund investors, side letter agreements that have preferential terms, conflicts of interest related to investments made by co-investment vehicles or other co-investors, and incentives for portfolio companies to use affiliated service providers. So here, OC found disclosures that services would be provided on terms no less favorable than those that could be obtained from unaffiliated third parties. But OC noted in the risk alert that advisors did not have procedures or backup to show whether comparable services were available from unaffiliated third parties on better terms, including at a lower cost. So this is something to watch out for. The second risk area focused on deficiencies related to fees and expenses, including allocation of fees and expenses among the advisor and its clients that was inconsistent with disclosure or policies and procedures, advisors that did not value client assets as stated in their valuation procedures and disclosures, and that is an area of acute focus in the illiquid environment in the markets this year, and advisors that have not had adequate policies and procedures to track or disclose fees. And the final focus area is on material non-public information and codes of ethics and personal trading. The SEC OC office found that advisors do not have policies and procedures reasonably designed to prevent the misuse of MNPI. And we highlight that OC identified the risk of whether MNPI could have been exchanged by employees, not necessarily was exchanged, including interacting with insiders of publicly traded companies, outside consultants arranged by expert networks, or corporate executives or investors that have information about investments. OC also found that advisors did not address risk posed by their employees who could obtain MNPI through access to office space or systems of the advisor or its affiliates that had MNPI. Another risk area related to trading restrictions and restricted lists. And finally, OC found that some firms did not enforce their own requirements for pre-clearance for gifts and entertainment, or did not identify access persons or require pre-clearance. So clearly some of these areas could be obviously the focus of private fund advisors, but also informative and instructive for advisors managing other types of clients. So the key takeaways, as with any risk alert, firms should review their supervisory, compliance, and risk management systems related to these risks identified and make any appropriate changes. And we are fortunate to have the co-heads of the OC Private Funds Unit join our Private Equity Committee meeting, which is scheduled for September 23rd. So please contact us if you're interested in joining that meeting. Laura, I'll turn it to you to talk about the cybersecurity risks that OC has observed since the shift to remote working as a result of the pandemic.
So OC put out a risk alert recently to share its observations of phishing and other attacks that deploy ransomware and have become more sophisticated. There have been some recent high-profile incidents that you may have heard about. OC encourages advisors to look at the Department of Homeland Security's Cybersecurity and Infrastructure Security Agency alerts on ransomware attacks, which includes strategies to reduce vulnerability. In addition, the risk alert includes a long list of beneficial measures that OC has observed in the areas of incident response procedures, operational resiliency, training and awareness, vulnerability and patch management programs, managing user access, and implementing perimeter security. The risk alert is worth taking a look at to stay on top of cybersecurity practices that OC is seeing in the industry related to ransomware. And just yesterday, OC put out a new risk alert on another method of cyber attack called credential stuffing, which is a relatively new cybersecurity term. It refers to hackers taking lists of compromised usernames and passwords from the dark web and using automated scripts to try to log in with them on other websites, such as an advisor's website, to log in and gain unauthorized access to client accounts and firm systems. This alert lists a number of ways to mitigate the risk of this happening, including updating your client account safeguards policies and your identity theft prevention program, requiring strict password standards, using multi-factor authentication, using CAPTCHA to prove the person logging in is a human, controls to monitor unusual or failed login attempts, and outreach to clients to recommend using unique passwords for each website, and cautioning that multi-factor authentication is not foolproof because a phone number can be fraudulently transferred to another device. With that, I will turn it over to Paul to talk about one more risk alert on LIBOR.
Thank you, Laura. In a June 18 LIBOR risk alert, the OC has highlighted the importance of the transition for investment advisors and other SEC registrants away from the London Interbank Overnight Rate, or LIBOR, to other quoted interest rates. In the US, the replacement rate is basically SOFR for the Secured Overnight Financing Rate. LIBOR is expected to disappear at some point. LIBOR rate quotations are not guaranteed to exist after December 31, 2021. As LIBOR disappears, the issue is to monitor the migration from LIBOR to an acceptable alternative and have in place, timely, all the practices, procedures, documents, and assets properly supported. On a personal note, I was sort of pleased recently to read a prospectus from a money market mutual fund that showed a whole page or so of SOFR obligations held in the portfolio. I was starting to see some tangible evidence of the transaction away from LIBOR right in my own mailbox. Maybe you have too. I assume that to assure that advisors and other affected firms are ready for the transition, the OC is conducting a limited sweep examination, a series of them on this topic, as we understand. If you've been examined, your exam might have been thorough and somewhat arduous. We've heard from one member who explained that requests were extensive. Not to get hopes up, but the SEC staff did walk back a couple of small number of the most burdensome or least relevant requests in this exam. Be prepared. This transition and firms' preparations are actively on the OC radar. Gail?
Great, thank you, Paul. Okay, let's shift gears again to the Department of Labor. We mentioned how busy it's been, and it seems like it's trying to push through quite a few rules that could have a significant effect on advisors. Sarah, you've already talked about the fiduciary proposal, but there are a couple of other important items as well, correct?
Yes, Gail. This summer, the DOL issued several proposals with tight 30-day comment periods. In addition to the fiduciary proposal, the DOL issued a proposal related to ESG investing. In the past, they've issued guidance regarding ESG investing that changed with each administration, but now they are proposing rule amendments, presumably to make it more difficult to change the rule in the future. The DOL shows broad skepticism for ESG investing in the proposal. The implication is that ESG investing decreases returns and increases risk. They also do not clearly distinguish between the integration of ESG considerations as part of the investment process and other ESG strategies. Also, some of the proposed provisions apply to all investments, not just ESG. In our comments on the proposal, the IAA asked the DOL to withdraw the rulemaking. We also challenged the DOL's assumption that advisors engage in ESG investment strategies for reasons other than providing financial benefits to participants and beneficiaries. We also made the point that historically, the DOL has not dictated what is a prudent investment process, and they shouldn't start doing so now. We raised a number of concerns about the proposed rule provisions and how advisors would comply with them. For example, there is a proposed provision that would require a comparison of how an investment or investment course of action compares to available alternatives that is extremely broad. We also took issue with the cost-benefit analysis, which assumed that fiduciaries would not incur much in the way of additional costs if the proposed changes are adopted. The DOL described as a benefit of the rule the societal resources freed for other uses due to lessened active management. We, of course, strongly argued against that and said that the DOL should not favor one type of investment over another or improperly limit investor choice. The DOL received many negative comments on the proposal, but we have also heard that there is significant interest by some at the DOL in moving forward, so we shall see. ESG and the next topic, proxy voting, are very political issues. So the DOL's most recent proposal regards proxy voting and the use of proxy advisory firms under ERISA. This would be a game changer in how ERISA fiduciaries have understood their proxy voting responsibilities for decades. Historically, the view has been that ERISA fiduciaries need to vote proxies, but under the proposal, a plan fiduciary would be prohibited from voting on a matter unless it prudently determined that the matter being voted on would have an economic impact on the plan. On the other hand, the fiduciary would be required to vote on a matter if it determined that the matter would have an economic impact on the plan. As for whether something has an economic impact, the rule would require the fiduciary to consider whether the matter will affect the value or performance of the investment. A fiduciary would be prohibited from sacrificing investment return or taking on additional investment risk to promote goals unrelated to the financial interest of participants or beneficiaries or the purposes of the plan. Now, if this sounds like a knock on ESG, it is. Like the DOL's ESG proposal, there is lots of skepticism about ESG in this proposal. And the proposed rules requirements are pretty challenging. And to address that, The DOL proposed examples of proxy voting policies that plans could adopt that are designed to help fiduciaries more cost-effectively comply with the obligation to vote or not vote. The examples include voting with management, only voting on certain types of issues like corporate events such as mergers and acquisitions, and not voting if a holding is below a certain threshold, like 5% of plan assets. However, it's not clear whether these policies would provide much relief for fiduciaries because some level of due diligence is still required to use them. Regarding proxy advisory firms and other service providers, a fiduciary would need to exercise prudence and diligence in selecting and monitoring them. The DOL plans to withdraw its previous guidance from 2016 on proxy voting. And that was issued because the DOL was concerned that then existing guidance dissuaded fiduciaries from exercising their shareholder rights. We plan to comment on the proposal, and comments are due on Monday, October 5th. Gail?
Great, thank you, Sarah. It's like watching a ping pong game a little bit. Let's move to slide 16, please, Megan. So that's it for the SEC and the DOL, but obviously things have been busy in other areas as well. For example, we now have new Global Investment Performance Standards, or GIPS. Paul, what should members know about the new GIPS?
Thank you, Gail. The GIPS has undertaken a major change in its standards for reporting investment performance numbers. And we've been encouraged in the process that IAA's recommendations have been fully considered and applied, including providing for increased flexibility to investment advisors in applying GIPS standards. As a result, some of the more troublesome proposals were moderated, and the standards are easier to apply in more circumstances. For example, GIPS is now easier to apply to pooled investment vehicles, to funds held by asset owners themselves, and by GIPS verifiers. The Global Investment Performance Standards for 2020 now appear in 3 volumes. GIPS 2020 for firms, like most of you, GIPS for asset owners, for certain sovereign wealth funds, pension plan portfolios, endowment funds, and other pools of assets held by the owners. And thirdly, GIPS 2020 for verifiers. That would apply to firms that verify others' GIPS compliance. Well, GIPS compliant firms are presently in the midst of migrating from complying with GIPS 2010 to GIPS 2020 standards for reporting investment performance numbers. Some other firms are applying GIPS in their space for the first time. The CFA Institute is publishing piecemeal its GIPS 2020 handbook in 8 sections. It's through most of it. The CFA issues guidance statements on particular topics, answers questions submitted to its help desk, and then publishes many of those questions with their answers. So this December 31 coming up will mark the end of the first year in which GIPS 2020 reporting will apply. So verifications under the new standards will take place in 2021. On a related note, Karen Vincent is the present CFA Institute Head of Global Industry Standards, and Karen will be addressing the next IAA GIPS Compliance Forum meeting on Thursday, November 5, 2020. If you or someone from your firm would like to join our IAA GIPS Compliance Forum, please contact me. Thank you.
Great, thank you, Paul. Monique, let's turn back to you. For the first time in years, the CFTC seems focused on advisors that are also commodity pool operators or commodity trading advisors. What trends are we seeing in that agency?
Thanks, Gail. So we continue to advocate for members that are registered CPOs and CTAs because of their trading of derivatives. We have over the years urged the CFTC to reconsider its regulatory regime for SEC registered advisors and to work with the SEC to tailor the agency's regulation of these firms to limit the duplication and costly burdens that add little investor protection. So there have been several major rulemaking proposals this year. First, the CFTC proposed changes to compliance requirements under the Form CPO-PQR for commodity pool operators. And we filed a comment letter with member feedback supporting this proposal and recommending some improvements to further reduce the burden of filing the form while still providing relevant information for the agency. The CFTC also proposed amendments this year to registration requirements for non-US commodity pool operators, which we generally support. And we do expect the CFTC to adopt these rules by the end of this calendar year. So that's what's happening at the CFTC. Gail, back to you.
Great, thanks, Monique. And I see we're at the top of the hour. We have just a little bit more material to get through, so please hang tight and be patient with us. Sanjay, let's turn it to you. I think probably the most interesting state development for members is NASA's proposal on continuing education requirements. To whom would that apply, and what has been the IAA's reaction?
Yeah, so the North American Securities Administrators Association, or NASA, has proposed continuing education requirements for investment advisor representatives that are registered in states that adopt NASA's framework. Specifically, NASA is proposing an annual continuing education requirement of 12 total credits. 6 credits would focus on products and practice. The other 6 would focus on ethics and professional responsibility. Now, NASA did request comment in a number of areas, including the content components. The IAA submitted a comment letter addressing these issues and offering our recommendations. In our letter, we, among other things, stressed that the continuing education framework should be effective and valuable for reps and not simply be a check-the-box compliance exercise. We do expect a final model rule by the end of the year. The states would then have to implement it into state law. And I also want to point out that NASA is requesting input on a no-name basis via an online survey regarding the potential course content for this program. And the link to the survey is on NASA's website if you're interested. So back to you, Gail.
Great, thanks, Sanjay. Well, Meg, could you go to the next slide, please? It has been a busy year, and it looks like it will continue to be extremely busy, both on the Hill and at the regulatory agencies. And that's likely to be the case regardless of what happens in November or December or January, depending on how long it takes to count our votes. But of course, the IAA will continue to be here to help you all navigate what may be some choppy waters. And as you can see on this slide, we have a lot of resources, and we encourage you to take advantage of all of them. Next slide, please, Megan. We also encourage you all to become engaged in our various committees and work streams. Our advocacy is made immeasurably stronger by your input and help. And for those of you who do work so hard with us on our working groups and committees, we are very, very grateful to you. Slide 19, please, Meg. I'd like to just briefly mention 2 upcoming events before I turn it back to Karen. As Neil mentioned, our Leadership Week is coming up. Registration is now open, and it's looking to be an excellent program. So we hope you will all join us. We are also going to be holding our annual compliance workshops virtually this year, no big surprise. They'll be in November, and we're going to try to do something a little bit different. We are hoping that the advertising rule will be out by then, and of course, if it is, we'll tackle it in detail. So please keep an eye out for registration for that. Karen, that is it from the team, so back to you.
Thank you so much, Gail. I'd like to add my plug for the IAA's Leadership Week. Leadership Week this year combines the business focus of our traditional leadership conference with the strong policy focus usually contained in our IAA Advocacy Day, which we typically held in June. The virtual format provides the flexibility for you to participate live in whatever sessions you choose and watch others on demand at your convenience and on your own schedule. We have a terrific program for you, and I hope you will join us. I want to thank Gail, Neil, and the entire legal team for a great presentation today, and for all of the substantive hard work that goes into all of the advocacy on behalf of our members. They do a tremendous job on behalf of all of you, so thank you. And I want to thank each of you for participating today. I hope it was helpful to you. As usual, if you need anything or if we can be helpful to you in any way, please reach out and contact us. And with that, have a great afternoon. Thanks, everyone.